Large global investors have played a major role in the AI boom, providing funding for the construction of data centers and network infrastructure. Today, we look at data centers through the perspective of investors. How do large private investors think about data centers as an asset class? What trends do they consider in their investment strategies? And how do they think about opportunity and risk in a fast-moving market? To help us unpack all of this, my guest today is Michael Hochanadel, the Managing Director and Head of Digital Assets at Harrison Street. Michael's been an investor in the sector for 20 years and shares his insights about how investors assess different types of properties and business models, and what the next phase of AI-powered growth might look like. Let's get started. Welcome to Data Center Richness. I'm Rich Miller, and I've spent 25 years telling the story of data centers, cloud computing, and AI infrastructure. In this podcast, I'm sharing conversations with the innovators building our digital future. Now, here's our show. Before we begin today, a quick reminder that this content is provided for informational purposes only and should not be relied upon as business or investment advice. You should consult your own advisors on these matters. Now here's our show. Michael Hochanadel, welcome to Data Center Richness.
Thank you very much, Rich. I'm excited to be here.
I thought a great place to start would be for you to tell us a little bit about yourself and your journey in the data center sector, and then maybe a little bit about Harrison Street and what it is that you guys do.
Would be happy to do it. So, I have been in data centers for 20 years now, which seems hard to believe, but I did my first data center deal in 2005. At that point, I was on the sell side of the business. I was a broker originally with the Staubach company, and then JLL acquired Staubach in 2008. And so I spent 15 years kind of overseeing data center investment sales on that platform. I joined Harrison Street and jumped over to the investment side in 2020. And obviously, I've spent the last 5 years at Harrison Street, building and growing our platform around investing in data centers and digital infrastructure. And so it's interesting having had the opportunity to observe the evolution of the sector for 20 years. As you well know, it's changed dramatically. And so some of the things that we were thinking about and doing in 2005 bear very little resemblance to how the market is operating today. At Harrison Street, so I joined in 2020, as I mentioned, to really build and grow our presence in the data center space. As a firm, we are an investment management firm. We tend to focus on sort of niche alternative sectors within real estate and infrastructure, generally things that we see as being both operationally intensive, such that there are some barriers to entry, but then also supported by persistent, positive demand fundamentals. And so, obviously, those things apply to data centers. But in addition to data centers, we do a lot in the student housing and senior living space and various other alternative sectors. We manage close to 60 billion across a variety of different fund products, really across the risk spectrum.
So the data center sector has had a pretty interesting journey from the early days. We've both been in the business long enough to remember the times when there wasn't necessarily a lot of investment interest in data centers, or some investors had trouble sorting out the sort of real estate, tech, and the risk factors. Uh, the rise of cloud and now AI has certainly seemed to change that, as well in some ways to the barriers to entry that you talked about. How would you assess how far the industry has come and where we're at right now in terms of the investment community?
Yeah, the way that I think about it, I think we're sort of at the inflection point where data centers are sort of evolving beyond sort of a niche alternative sector into a mainstream asset class. I think that shift is happening in real time for a variety of obvious reasons. But if you go back to 2005, it was a very niche sector. There was almost no institutional capital organized around the space. Um, very little understanding around kind of the long-term prospects of these assets, what that meant relative to residual value, and therefore not a lot of capital. And the capital that was there was really underwriting mostly around the credit of the tenant and looking to sort of fully amortize returns, over the course of a lease. I think that just the sheer magnitude of the fundamentals behind the data center space, it has obviously grown, dramatically differently than the other conventional real estate sectors. And so, at some point in time, when you just track that growth, it 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 sort of leaps beyond alternative and becomes a mainstream asset class. And I think when you think about that growth and just how sound and positive the underlying fundamentals are, capital has been attracted to the sector and really sees the merits, in a way that maybe is different than some of the concerns that's oriented around some of the legacy conventional asset classes, whether that's office or retail or whatever the case may be. So I think we're in real time kind of living through this shift of data centers evolving, beyond niche into a primary asset class, and that's being supported by capital, really from every pocket, all of the institutional sources, both on the real estate side and on the infrastructure side.
I'm interested to hear how Harrison Street thinks about the data center sector. Oh, you've got an interesting mix of holdings, which we can talk more about in a minute. But what are the themes that you're interested in looking at the opportunities in data centers and digital infrastructure?
Yeah, so as you mentioned, we do invest across a variety of the different sort of subsets of the broader data center asset class. I think the way that we think about it, we want to be providing capital to the various components of the overall kind of application and network architecture that we see as being the most strategic, and that give us what we see as being an opportunity to generate outsized returns. And so right now, I would say that really falls into four categories. I think that may expand a bit, and I think we'll get to this a little bit later in the conversation. But right now, the four things that we're ultra focused on are, um, and I'll kind of just go in order of size. But the first would be just kind of large scale campus development. I think this is an area that has seen most of the capital flows just by virtue of the sheer scale of these projects, right? And I think also this is the area where the end user community needs the most help. So it's really around finding locations and preparing sites to deliver 300 plus megawatts. I mean, now we're starting to talk about gigawatt scale campuses, which again, if you said that in 2005, you'd be laughed at. But so we're spending a lot of time there. I think from a location perspective, we tend to focus on locations that are either part of an existing established data center market or proximate to and kind of the path of growth out of those markets, or maybe some of the emerging secondary markets. I think we tend to shy away from the locations that are a bit more tertiary. And I think again, just sort of anchored to real estate discipline and kind of a real estate lens, we care a lot about long term residual value and sort of how things would be repositioned beyond the initial tenant. So, but that first category would be large scale campus development. Um, Second category, I would say, on the total other end of the spectrum, would be interconnection. We have a portfolio of carrier hotels that we own and operate with a partner, 1547, who I know you know. And very different business model. Does not operate at the same scale as the hyperscale campuses, but it's very strategic from our perspective in a variety of different ways. I think one, um, interconnection, the occupancy that you have in interconnection assets is incredibly sticky by virtue of its strategic nature for those customers. There tends to be some interesting kind of outsized revenue growth opportunities that come with network expansion, and then also just the relationships with that you have with the network, consumers and network providers tends to provide insights in terms of kind of thinking through broader decisions around location decision. Um, and then I would say building from that, we still do take a strong interest in co-location. I think that's a segment of the market that's been somewhat overlooked as everybody has moved, up the scale continuum. But there are still, plenty of requirements that require a dedicated physical environment. I think we tend to focus on highly connected co-location environments. I think that tends to provide a strategic advantage. And then continuing with the connectivity theme, we're very interested in connectivity infrastructure more broadly. We are an investor in a dark fiber platform. That's a business that we love. A little bit different than some of the core data center segments that I described, but catering to the same end user community, and in some ways, really creating interconnection opportunities and interconnection economics at market scale. And so those are the four segments that we're focused on right now. Again, kind of across the risk spectrum, we have opportunistic money for development. We have core and infrastructure money, for assets more on the stabilized side. But in terms of the underlying asset themes, that's kind of where we spend our time.
So let's talk a little bit about your investments. I know you guys have worked closely with PowerHouse, was spun out of American Real Estate Partners, and also 1547, which you mentioned, which have slightly different sort of positioning within the market. Um, Tell me about what you like about those two investments and where they fit, and then if there's things I've missed, maybe share a little bit about those.
Yeah, I mean, I would say, big picture, taking a step back, as a firm, we structure our investments as project level joint ventures, where we then develop programmatic relationships with operating partners. So the groups you mentioned are two of our primary kind of core operating partners. Yeah, yeah, again, very different profile, but 1547, that founding team has been in the business, a little bit longer than I have, quite frankly. They were around going back to the origins of Telex, which obviously became Digital Realty's interconnection business, and so just a wealth of experience and knowledge in terms of the nuances around how to operate an interconnection environment, and we've seen that benefit our investments significantly across the country. PowerHouse is a little bit different, as you mentioned. PowerHouse is the data center division of American Real Estate Partners. They're a group that I've known going back over 10 years to when I was on the brokerage side. And, they really started their data center business built out of just exceptionally strong development capabilities in Northern Virginia. And at the end of the day, developing a hyperscale campus is really a real estate development project. And so having in-depth knowledge of how a region operates, how the players and market participants in that region operate, being able to navigate, the various, complexities around power, planning and permitting, et cetera, is incredibly crucial. And so they've been able to leverage, all of that expertise and experience, to the benefit of our collective investments. Um, Beyond those two, we have a couple of other operating partners as well. One of which is a company called Oppidan. They're really a developer based in Minneapolis with national capabilities. a little bit more under the radar, I would say, from PowerHouse, but their customers, love them because of their strong development capabilities, kind of moving in and out of various markets, kind of in collaboration with customers. Lincoln Property Company has been a partner of ours. They've been in the data center space for a long time, longer than many by virtue of their rack house platform. And then the dark fiber, business that I mentioned is Summit Infrastructure Group, which is the dominant dark fiber provider in Northern Virginia.
Yeah, those are some. It's an interesting mix of investments hitting a lot of different parts of the market. Um, like 1547, for example, has an interesting mix of markets, including they just acquired DR Fortress, I guess, in Hawaii, which is an interesting local market. How are they thinking? I guess that must be part of the connectivity.
It's yeah, I mean it's all about connectivity, right? So it's the convergence of metro connectivity, ideally some angle around long haul as well. In some ways you can think about kind of network architecture and application architecture with data centers and draw some parallels to logistics. And so you've got your big bulk warehouse distribution, you've got your last mile, you've got kind of intermodal. And so from a network standpoint, we really like the convergence of kind of metro interconnect and long haul. And so Hawaii is a particularly interesting take on that because you've got the subsea there. A lot of the subsea kind of terminates and reroutes, around the Hawaiian Islands. And then you've got a density of, in addition to obviously being the major, connectivity kind of metro market in the islands, you've got, satellite communication. So it's sort of an interesting mix of a couple of different, connectivity themes that play, across the islands.
You mentioned co-location and that perhaps it's being a little bit underserved. I think we've all seen the focus on these enormous campuses that we talked about before, where you're getting into hundreds of megawatts, even gigawatts. Those are primarily focused on hyperscale players, a lot of single tenants in those, taking those buildings and campuses, which from an investment perspective, I think is a simpler way to understand the investment, particularly for real estate folks. At the same time, I've been wondering for a while about the enterprise IT market, and if anybody is really still building the 2 to 4 megawatt pods. Do those have utility anymore? Is it 6 to 8 megawatt pods? But what's your take on where the enterprise is in terms of the products that are being offered in today's market?
Well, to your point, it is getting larger. So I think the 1 to 2 or 2 to 4 megawatt pods has definitely become 6 to 10, eight to 12, kind of consistent with how everything's kind of happened across all elements of the market. But I think the piece that is going to kind of amplify pressure on that segment is the rollout of inference, which I'm sure you were going to get to in your questions. But if you think about it, in many ways, inference is going to require that same type of facility, both in terms of size and location, and it really doesn't exist right now. I mean, nobody's been building that. And so, I think there's going to be a really interesting opportunity for some first movers to start to roll out kind of a primary strategy around building, probably in the 20 to 50 megawatt size range, to capture the demand profile that you described on the enterprise side. Plus the emerging need for inference, which we think is going to be probably on the larger end of that scale, depending on market. But if you take a step back and just think about, how AI works, most of what we've seen so far has been AI training, which really kind of ties back to that ultra large scale campus concept that we started talking about. um, a little bit less oriented around location. I mean, latency is less important for training. It's really just about, power throughput, and kind of a very like highly densified, size and location is a little bit less important. Inference is going to be totally different. Inference is going to be highly latency sensitive. I mean, inference is going to be the portion of the AI workload where the models are interacting in real time with end users. And so, you know, I think to function properly and get the most out of what those models offer, the latency is going to have to be, exceptionally strong. And so you're going to be looking at, you know, it'll still require, dense deployments, but it's not going to be nearly the same amount of power. It's going to be much more distributed. It's really going to be what, we've all talked about, sort of the edge being. We've been talking about the edge for 10 years, and it never really materialized, I think, in the way that people expected. But I think inference is going to drive that. And so, 20 to 50 megawatt deployments across all of the important metro areas, um, is going to be, infrastructure that needs to get built. And so I think that'll be an opportunity, for us on the investment side, and I think for operators to start to build their platforms around that.
So that raises some interesting questions. First of all, with inference, it's interesting that I've heard a number of different sort of theories about how inference might translate into infrastructure. Some folks think that a lot of inference can be done from large centralized footprints. Others see new data centers everywhere, except maybe not in like the old edge model where we're talking about a couple of modular units. Instead, it's a 20 megawatt data center. And there's other folks who will, say that an increasing amount of the work is actually going to be done on the devices as devices and smartphones get uh, more powerful and customized for AI. What's your sort of thesis about how that works? And I want to ask a little bit more about risk in a moment. But one of the sort of characteristics of Edge in the beginning and that whole movement was people were cautious about getting too far out over their skis and going after Edge deployments and letting them get ahead of the business model. So, what's your take about what inference is going to look like and where?
I mean, I think it's probably, a little bit of all of the above, but I think the most important piece is going to be, distributed compute in metro areas in that 20 to 50 megawatt chunks. I mean, I think if you go back to the ultra large campuses and tertiary markets that have been popping up to do training, I guess a couple of things to say about that. I mean, could they do some inference? Probably, but only portions of the inference that I think are not interacting in real time with a person somewhere, right? And there could be those application use cases. I mean, it could be inference that is maybe a back end for some kind of, enterprise SaaS application, for example, where maybe it's behind the scenes processing, or, some level of batch processing, supporting a corporate enterprise's, systems. But, the types of inference that I would say, we as individual consumers interact with, whether that's, models embedded in-home devices, or models that you're accessing, from your PC or computer. I mean, if you're interacting with it in real time, it needs to have ultra low latency. And so, if you're sitting here, I'm in San Francisco right now. If I'm sitting here in San Francisco and I'm interacting with the inference portion of a large language model, that's not going to be hosted in the Dakotas. It's just not going to work properly. So, it's going to either be in Santa Clara, or some of the emerging, markets kind of picking up some of the overflow from Santa Clara, Reno, and some of those kinds of markets. And so, But I think the next evolution of that is it's probably a better example to pick a city that maybe is not an existing kind of core data center market. So if you think of maybe like, St. Louis, for example, which I've never understood why St. Louis isn't a bigger data center market, but that's a separate point that we can get into. But if you look at St. Louis, um, if you're a person interacting with a model and to optimize the performance of that model, I think there's going to need to be a cluster of compute in that size range that I described, that is serving up the market engagement portion of that model, satisfying the inference compute, for that customer base. And so it's this proliferation of infrastructure that's needed kind of across all these major metros. And I think it's probably, I mean, it's not unique to the United States either, right? I mean, I think this dynamic is going to be required everywhere that AI is adopted. So it's across Europe and the Pacific Rim. And by the way, I think the use cases for AI are going to be limitless. I think we're not even scratching the surface in terms of the commercialization of AI, and just kind of the market adoption and the different various use cases that we're going to see.
Yeah, it's wild when I see some of the emerging use cases. Every now and again, I've been looking at the development of agents, the whole agentic AI, and some of the possibilities there are pretty wild, that are going beyond just the sort of early business cases around generative AI. How do you see that? You mentioned it being limitless. What are the things that you think are most interesting in terms of the AI business models?
The first places that you're seeing it pop up are kind of efficiency and optimization. And I think that the first, people that are acting as early adopters are the ones that are most sophisticated around technology. And so I would say, coding is probably the first place to start. Um, and one interesting aside, which I didn't talk about when I was talking about my background, but before I got into real estate, I actually spent 4 years working in software. I'm not a computer scientist, by any stretch, but I did enough of that work to at least have a peripheral understanding. And I think ultimately that's kind of what led me to sort of gravitate to the data center space. But I think for that cohort, which kind of understands how to navigate and interact with technology, it's creating just unbelievable efficiency gains in terms of one software engineer's ability to do what it took 20 or 50 engineers historically. And I heard a really interesting comment made, definitely not attributed to me, but I think it's true. Good AI that's kind of well suited to the task at hand, it can make 90% of what you know and do, worthless, but it amplifies 10% of what you know how to do, a hundredfold. And I think that's a really good way to think about it. And I think right now that's being applied, to that category because that's a universe of users that's well versed in navigating it. But I think you can take that same concept and apply it to a lot of different things. You can apply it to a lot of the work that underpins what I do on the investment management side, as far as underwriting and putting together investment memos or whatever the case may be. You could apply it to what you do, from a media standpoint, just in terms of having an AI, assistant kind of help with a lot of the underlying work required to produce the product, and you can really just proliferate that across the totality of the economy. So I think the big question then is it is it a productivity enhancer that's net positive and creates jobs and economic activity, or is it somehow consuming jobs in an unproductive way. I think the jury's out on that, but again, I think if you just kind of map that concept against the economy, there's, I mean, literally an endless range of alternatives in terms of how to commercialize AI.
Well, that notion of the jury being out and the early stages that we're in raises some interesting questions, in some folks' mind anyway, about investment risk. Because of the size of some of the announcements that we've seen, it just seems really big and a lot of money to underwrite that kind of growth. So some folks worry about bubbles. Uh, I'm curious on your thoughts on that, but also data centers are long-term assets, like 20, 30 years. And one of the things we've seen lately is that the hardware that lives inside of them seems to be getting on a shorter and shorter time frame of refreshes, at least at the cutting edge end of the GPU market. Every year, NVIDIA's got something new that seems to have a completely different power and usage profile to than its previous version. Is the risk environment any more complicated now, or is it pretty much the same, only larger?
A couple of thoughts. I think we obviously spend a lot of time thinking about risk mitigation. Um, I would start to just kind of emphasize a point I made earlier about location strategy. I mean, I think again we tend to shy away from the ultra tertiary locations, and mostly because of concern over long term residual value. I think if you control sites with power, in or around major data center markets and metropolitan areas, just from a pure real estate fundamental standpoint, we think there's long term residual value there. So I think that's probably the first place to start. Um, I think the second place to start in some of the larger development projects that we've undertaken, um, we've tended to focus on powered shell historically. Not that we can't go turnkey, but I think the powered shell model is particularly attractive from a risk mitigation standpoint because you're really anchoring your investment to the portion of the overall investment that really is an appreciating asset over time. Definitely recognize that the point you're making about useful lives of some of the equipment, and so that can still be a very attractive investment, but you do need to be thoughtful about the return profile up front to make sure that you're getting compensated for that, that basis risk or residual value risk. Um, the other uh, the other comment that I would make is that you hear the term bubble thrown around. One of the nice things about our market is there's sort of a natural governor to oversupply being built, which is the availability of power. If power weren't such a constraint right now, and you had developers and investors going out there and just building gigawatts on spec, I think this would be a very different conversation. But that's just not how the market operates. So it's really a function of advancing power infrastructure kind of um, in a manner that is paced consistently with the real time demand that we're seeing from customers. And then, ultimately, when most of the dollars go into an investment, there's a customer involved at that point in time. So, there are all of these levers that get pulled that impose discipline and act as kind of risk mitigation for the market. It's and we're not alone in focusing on all of these points, but um, I think where you could be exposed would be again some of these tertiary market locations. One question I have in my mind is you know we're going through this phase of rapid evolution where all of these models need to get trained up, but once they're all trained, will we ever go through a period where they need as much compute to continue to do that training? I'm sure there will always be, optimization training, but that's one concern I have. And then um, beyond the primary customer cohort of the five hyperscale customers, I think there's credit risk as well that needs to be understood and underwritten. And I think there are going to be winners and losers. I think there are going to be some companies that kind of jump into that hyperscale category, actually, and I think there are going to be others that maybe have a hard time kind of capturing market share. So, um, yeah, I think those are the primary things that we think about from a risk mitigation standpoint.
Well, Michael, listen, this has been a fascinating conversation. There's a lot going on, not just in the data center development world, but also in how it's all financed and delivered. So I appreciate you spending some time with me to help our audience understand what you're seeing and what some of the trends are.
Yeah, I love doing it. I appreciate the invite. I think this is a great format. Making it a little bit more interactive. But so happy to do it. Happy to do it again when the time's right. And appreciate all of the content that you produce. It's definitely um, things that I've consumed, over time, over the time that you've been doing it. So keep up the good work.
Thanks so much for tuning in. If you enjoyed today's episode, please take a moment to give us a like on YouTube or leave us a review on Spotify or Apple Podcasts. Your feedback helps us grow and bring you even better content. Don't forget to hit the subscribe button so you never miss an episode. See you next time for more data center richness.